Good morning, ladies and gents, and welcome to the November 2025 edition of the Blackfinch 10-Minute Market Forecast. Thank you for joining us. My name is Jordan Kent, Distribution and Sales Exec for Blackfinch Asset Management. My co-host today is Mr. Josh Clayton, Blackfinch Group Listed Product Specialist. For those joining us for the first time, we use this webinar to provide you with what are, in our view, some of the key headlines across the globe, shaping markets to keep you informed, ready for your client conversations. If you have questions, then be our guest and submit them using the Q&A box at the bottom of your screens. Otherwise, at the end of the session, we'll provide you with our contact details to reach us directly. Before we begin with today's content, it is important for me to note that the information we cover today is intended for financial professionals only, and therefore shouldn't be interpreted or taken as financial advice. So, the three areas we'd like to cover for you today are as follows. To begin with, we focus on the USA, where it'd be fair to say that the Fed's Reserve's latest 25 basis point cut was expected, but with key data delayed and policymakers now operating in a fog, we'll explore whether the Fed may have enough clarity to cut again soon, or whether patience is the safer path. Next comes the UK, where although inflation and wage data continues to soften, the Bank of England appears to remain cautious. We'll consider how long they could hold rates steady before market pressure builds, and whether the upcoming autumn budget or fresh data may finally tip the balance towards easing. And finally, our attention turns to Japan, with strong market returns meeting a chapter of uncertainty. With the new Prime Minister favouring a slower approach and the Bank of Japan still debating its next move, we question whether politics could delay policy normalisation or if Japan could stay on a steady inflation path. So across all three regions, we find central banks walking a very fine line, balancing progress on inflation against growing uncertainty in data and politics. So the question now is whether this cautious tone marks a turning point or whether it's simply a pause before momentum builds again. And so with that, I'll hand over to Josh to unpack each of these themes in more detail. Good morning, Josh.
Thank you, Jordan, and good morning, everyone. Let's get straight into the first theme today. So the Federal Reserve delivered that 25 basis point rate cut that Jordan said last week as expected, but what really moved markets wasn't the cut itself, it was what Chairman Powell said afterwards. So he went out of his way to push back against the idea that another rate cut is already on the table for December. And before his comments, markets were pricing in a 90% probability of another rate cut at the December meeting. But as we can see in the first chart on the left, those odds sharply dropped afterwards. It was closer to 70% as everyone recalibrated their expectations. And Powell said the Fed was operating in a fog, and that highlights the lack of clarity in the incoming data. And a lot of that is due to the recent US government shutdown that's delayed a lot of key economic reports. And I referred to the shutdown in the previous webinar, and its duration really has surprised myself and many. And this feeds into the outlook for US employment I'll come on to in a moment. But just talking about this fog, it essentially means the Fed wants more time to assess whether the economy is slowing or if the recent softness is just noise. And at every press conference, Powell always repeats that the Fed isn't on a preset course and that policy decisions are going to be made on a meeting by meeting basis to the incoming data, not by who may be in the presidential seat. So I think the Fed's next moves are now likely to hinge on the labor market data and wage trends over the next couple of months. But if we move onto the chart on the right, I think the picture becomes much clearer in terms of US inflation, and we're seeing continued US disinflation beyond just core goods, which was the first category to cool after the pandemic. But now inflation in shelter, which measures the change in housing costs for consumers, and then your core services ex shelter is also easing. And these two components make up roughly 3/4 of core CPI. So I think just shelter inflation, for example, it's dropped from 8% year on year at its peak in 22 to nearer 5% today, and broader services inflation's drifted lower. So what does it all mean? I think from the chart, disinflation appears to be the key focus for 26. Risks are tilted to the downside. A lot of people are believing that tariffs are going to turn out to be this one-time increase in the price level and then eventually drop out of the figures. But it's the shelter component that has the heavier weight in the makeup of the figure, and that's firmly falling. So the Fed is likely wanting to look to its other mandate, which is employment and what goes on in the labor market. And ideally, An end to the government shutdown, more regular publication of economic data is going to lift that fog. But until then, they're going to have to rely on private sector data, releases, anecdotes, surveys. But even they are pointing to this softening in labour market conditions. And that will alleviate the Fed's near-term concerns on inflation because it's going to make it difficult for tariffs to spill into higher wages if there's growing slack in the labour market. And for our multi-asset portfolios, a softer labour market and lower inflation is absolutely an opportunity for our longer duration holdings. So let's see how it unfolds as the year comes to a close. So if we go on to the UK, the focus now shifts to the Bank of England's upcoming Monetary Policy Committee meeting this Thursday. And even though we've had another round of softer than expected inflation and wage data, it's looking like most MPC members are still leaning towards holding rates at 4%. And the data since September has been a bit of a mixed bag. Services inflation is about 4.7% in September. Private sector pay growth is eased roughly to 5%. That's also below projections. They're all encouraging signs that underlying price pressures are starting to cool. We may have seen the peak, but I don't think the bank feels comfortable enough that that's enough to justify another immediate cut. And this is what the chart is showing. There's a bit of a disconnect that's emerging between market expectations and the bank's own policy assumptions. Markets have become more dovish. They're pricing in around a 65% chance of a 25 basis point cut by year end. It was up from 27% a month earlier, but the November forecast shown in yellow is still conditioned on an older and higher rate path that's taken from the August monetary policy report. So in other words, the bank's internal models won't quite yet reflect the dovishness we've seen in markets. And that matters because it means that the MPC's updated forecast will probably look more hawkish on paper, implying inflation remains above target for longer, even though in reality the latest incoming data has been softening. And that's it creates a bit of a communication challenge for the bank, where they don't want to appear behind the curve, but equally they're wary of easing too early. And if we look ahead, the next few data points are going to be key. The autumn budget on the 26th of November and the labour market releases ahead of the December meeting are likely going to shape when the bank feels confident enough to resume cuts. For now, officials appear to be in a bit of a cut and hold phase. They're pausing to gauge whether pay growth and services inflation can sustain a downward trend. And we are still seeing some sensitivity in UK pricing at the moment. If we're looking at UK stock market indices, it's the FTSE 100 that's been breaking all-time high records, not the lower end of the market like AIM or FTSE 250. And if you break down the FTSE 100 index, many of the names are defensive in nature. They have robust balance sheets. And I think this talks to a lot of the sentiment at the moment. A lot of investors are still preferring to hold these names rather than the more speculative, higher growth companies that the UK has to offer. And in our view, the autumn budget has caused a bit of a weigh on sentiment at the smaller end, and there's still a lot of uncertainty on fiscal policy. But for our multi-asset portfolios, we favoured holding the FTSE 100 index. It's captured a lot of this trend over the year, and where we do have smaller cap exposure, we've preferred to hold actively managed funds in the sector that can find some stronger companies with better pricing power that can pass on these costs to consumers. And a good example of that was the national insurance contributions last year. But for the moment, we are comfortable with the UK positioning, and we're going to see what happens with the budget. So finally, Japan. And it's actually where the story's been less about inflation, which is a chart on here, and more about policy uncertainty. But if you're looking at the market generally, Japan's generated stellar returns recently. Just looking at October alone, the Nikkei 225 has reported a discrete monthly return of nearly 13% in sterling terms. It's gone down as one of the highest increases since January 1994. So sentiment's been boosted by this hope of strong and large scale stimulus from the newly elected government, as well as the Bank of Japan leaving its policy rate unchanged at 0.5%. And the decision in the October meeting ended in a 7-2 majority. There were two board members that wanted a hike, and most economists, including Oxford Economics, who generated this chart, they still expect one final increase in December to 75 bips. But politics has made it a little bit less certain. The new PM's been very clear. She wants a cautious approach to monetary normalization, and that's something the Bank of Japan's been trying to do. It's trying to catch up with other developed regions like us here in the UK, like the US. And she's emphasized the need for very close coordination between the government, between the bank, and markets have interpreted that as a signal that policy tightening could be delayed into the new year. But just on the data side, the backdrop is still encouraging. This was something we talked about in the last webinar, but bringing in the chart here, the Bank of Japan's inflation forecasts still point to core CPI. It's inflation, take away your food and energy, holding roughly around the 2% mark through 26. And that's what the chart is showing. And most of the earlier price spikes from food and energy, they're fading, and inflation is expected to stabilize smoothly around target over the next 18 months. And that means the Bank of Japan can afford to move slowly. And the message here is that Japan's inflation path looks smooth, but the policy path doesn't quite look as smooth just yet. I think the Bank of Japan's gradual normalization story remains intact, but the timeline can easily slip depending on politics and wage negotiations in the new year. So for now, it's steady progress on inflation, but a cautious central bank walking a bit of a tightrope, a bit of a fine line. So just to wrap up, putting aside all of the hype behind AI, we are starting to see disinflation in the US become one of the key themes for 26. Inflation pressures are broadly easing across most sectors. There is still very strong price momentum behind the US at the moment. Earnings season's going on. As of Friday, roughly 64% of S&P 500 companies reported earnings, and of that, over 83% have beat estimates again. So the equity market is still very bullish. There's potential for more of that, especially if we see interest rate cuts in 26 from softer inflation that supports the narrative. The UK, the MPC, they're taking a measured approach to policy. They're acknowledging the softer data, but keeping rates steady until there's clearer evidence of inflation going on a sustainable downward path back to target. For our portfolios, we maintain conviction in our current weightings. We have that preference for holding predominantly large cap companies with the defensive element that we've talked about. And we do have active satellite positions, picking smaller companies where appropriate. And finally, Japan. It looks like inflation will moderate to around 2%, but policy uncertainty under the new government is clouding the Bank of Japan's timing on when to do it. Equity markets are very buoyant since her arrival. She does appear to be very pro-business, but with any new government comes some uncertainty while they settle in. So we wouldn't be surprised to see some sensitivity in pricing over the near term. But that's everything from me, Jordan. So I'll pass back to you for the wrap up. Thank you.
Thank you very much, Josh, and thank you everyone for choosing to spend your morning with us. Now, as promised, if you'd like to contact us directly to discuss any of the items we've covered or perhaps haven't covered, please be our guest and reach out to us with the details that are on screen for you now, as we're on hand and happy to help. And so that concludes today's session, and we hope you'll join us next time for the final edition of 2025, which will be at the same time of 8:50 on Tuesday, the 2nd of December. What's left for me to say is from me, Josh, and on behalf of all of us here at Blackfinch Group, is to wish you a pleasant morning, and we look forward to speaking with you again very soon. Bye for now.